Miscalculations.
I know. Lucky. Yeah, no, it's we just had some lightning strikes like right down the street.
Miscalculations.
It was fun. Hi, Dan. Lucky. Yeah, I know. So we're just gonna wait a couple more minutes and let some more people trickle in. Everybody have a good weekend? Yeah? Nice. I finally got out on a date night on Friday. It was awesome. Yeah, my wife Jenny and I went out for dinner downtown, and we got to see Chelsea Handler. I don't know if you guys know who she is, but she's a riot. She was so funny. Yeah. And we even got a hotel room. We didn't need to go home. It was awesome. No kids for an entire night. Spectacular. I love the haircut, Dave. Anybody have a good weekend? Anybody, you guys do anything fun?
Very low key. Very low key.
Yeah, good weekend, but nothing too exciting.
Yeah. I'm just digging the rain. It's so nice. Be
It
raining
is.
outside.
Yes.
So we've been facing a lot of issues recently, getting borrowers coming in with all sorts of different types of income, right? Different, especially nowadays. I feel like a lot of people in the past couple of years have already transacted. A lot of people have purchased or refinanced their homes in the past couple of years. It was kind of that huge flurry to get onto the gravy train, right? Everybody kept hearing about how well homes were doing and the return on their investment that they were getting. And all of a sudden we had this shortage of supply, right? Which is still kind of going on out there. And we just had so many people trying to buy a home. And so now we're still facing that shortage of supply, but obviously interest rates have gone up. They've more than doubled just this year alone since the springtime. And so it's literally created, it's just a much more difficult situation for people to afford a home. Let's be honest, right? I mean, even without prices coming down, if your monthly payment goes up by 50%, that's a chunk of change. Like imagine if your rent went up by 50%. Like what would you do? it would be horrendous, right? So we've been facing a lot of folks that are coming out there and still applying for homes, which is great, because those that can afford a home are actually in a spectacular position to be able to negotiate. As you guys know, those of you that were in the industry for the past couple of years, there wasn't a single time where you were putting in an offer below asking price. Not once. Not only that, but you were also jacking up the price, what, $50,000, $100,000 just to get in the game? You're releasing your contingencies, your inspection contingencies, your appraisal contingencies. I mean, it was a wild, wild west. It was kind of crazy the past few years of trying to buy a home. Well, now things have settled down. Now all of a sudden it's shifting to a buyer's market, and like all the buyers disappear because they're scared of the monthly payment, right? So what does all that have to do? What does that monthly payment have to do with the type of job that you have, with the type of income that you have? Well, the underwriters, right, for your loan, you guys all know what an underwriter does for a bank? Besides Dana, you're not allowed to answer this. Anybody else? So real quick, the underwriter is a person that works for the bank that determines how much you qualify for. And they also determine whether or not to lend you money in the first place, right? It's not Matt or myself or anybody else, any other loan officer out there for that reason, right? It's the underwriter. And that person has the obligation of looking at the 3 C's, you guys, right? There's credit, there's collateral, and there's a capacity to pay back the loan. I should do the Steven thing, right? There's a credit, there's a collateral, and there's the capacity to pay back the loan, right? And so Credit is super easy, you guys. Somebody applies for a home loan. We get the application, we get their birthday, their name, their social, we click a few buttons and boom, we run their credit and it imports all of their liabilities. And what's a liability? It's their debt. The total amount of debt that you have, but more importantly, that monthly amount that you owe, right? Because that's what a bank's going to be looking at. They look at the collateral, right? Second thing, they look at the collateral. Where is your down payment coming from? Is it coming from savings? Is it a gift? Are you taking it out of your 401k? Did you try to shove money from underneath your mattress to try to buy a home? Because that's not going to work. Okay. So no mattress money. No cash deposits, no large cash deposits, right? So they look line by line, literally. That's why we ask for your bank statements. They look line by line to see what kind of money is coming in there. And not only do they look line by line up to your last bank statement, but then they ask you for a transaction summary from the very end of that last statement through when you deposited that earnest money deposit, because they need to see where this money is coming from. Okay, it's really important. Part of our job, believe it or not, working for the government and enforcing the Patriot Act and making sure that there's no money laundering going on. And obviously, when you're borrowing hundreds of thousands of dollars, it's kind of easy to funnel money in one way or another, to take dirty money and buy a house with it. And then next thing you know, you refinance and pull it out. So we need to do our job in stopping them. Okay. So that being said, we talked about credit. We talked about collateral. The other part of collateral, right, is going to be buying your home. It's going to be the actual home. It's going to be that appraisal that the bank needs to do to verify whether or not the value of that home is actually what you're paying for, right? Because again, another kind of kinky way of maneuvering monies around would be if somebody was to say sell a $400,000 home for $800,000. Big chunk of change that they could just kind of move to somebody else, right? And so the bank's not going to lend $800,000 on the $400,000 value property. They're going to lend the lesser of, right? So, what's up, Eric? So you have your credit. We ran your credit. You just need to overcome the hurdle, okay? We got over collateral. We know where your money is coming from. We now know the value of the house. Now, the most important part, you guys, and what I want to talk to you about today is the capacity to pay back that loan. All right. And this didn't exist in the heydays. Like, nobody cared about your capacity 15 years ago. You can literally like fog up that mirror and here's $1 million. Like, it was crazy. Like, nobody cared. And so that's really what caused the entire market crash, okay, back in 2008. The entire market collapsed because we were lending people hundreds and hundreds of thousands of dollars that were working minimum wage jobs that had no business borrowing this money at all because they had no way of qualifying. They didn't have the capacity to pay back that loan, right? So now what we do is we look at their monthly income. Yeah, stated income. That's right. I make $1 million a year. Give me $500,000, I'll pay it back. Right. So now we dive deep. That's why this market, you guys, is so much different than the last market. That's why when everybody was like talking about crashes just 6-9 months ago, it's not going to be caused because of us. There's other bubbles out there, government debt, student loan debt, that kind of stuff, right? But it's not going to be us, okay? Because why? We have made sure that everybody that has borrowed money since that crash had the capacity to pay that back. That's why you're seeing so many fewer defaults nowadays, okay? Because these folks had jobs, they qualified, and they qualified at much more stringent criteria and guidelines, all right? So look, we take a look at your monthly debt to income ratios, okay? What does that mean? So remember I told you the first thing that Matt and I do when we take an application is we run your credit. We have to. A lot of banks, you guys, they don't do that. They don't run it. They'll ask you on the application, what are your monthly debts? And you put it in there and you screw it up and you don't enter it. Well, guess what? Your numbers are all skewed. You're going to get a false positive. You're gonna get a qualification letter that you had no business in getting. For an example, I recently had a Uber driver, okay? Makes $171,000 last year. 171,000 money, right? That's significant chunk of change on his Schedule C. And we'll go over a Schedule C in a minute, okay? But guess what, you guys? After he wrote all of his expenses off, he made $45,000. And he is applying for an $800,000 loan. Now, if you do the math, $45,000, it's not even $4,000 a month. $800,000, you're pushing $5,000 a month right now, more. So help me understand how you're going to pay $5,000 a month in monthly payment when your income is like $3,500 a month. You're not, right? But yet on his application, he put that he was making about $12,000 a month. He doesn't know. He doesn't know how banks calculate your income. Nobody does. You know who does? It's us. Not even all of us. I'm not going to lie to you guys. There's a lot of really horrible loan officers out there that just roll stuff up against the wall and just hope that it sticks. They don't know how to calculate income, and they don't bother putting in the extra time and effort to make sure that they figure it out right. And they don't have the same resources that Movement has, because we actually underwrite these loans up front, right? And so let's go back to your debt to income, right? Those debt to income levels, when you're talking about a government loan, for instance, right? A VA loan, you can get all the way up to 65% debt to income. When I see a veteran applying and he's pushing his limits to 65%, that means 65% of your gross income, and I can gross some of that up because it's non-taxable. 65% of your gross income is going towards your debts. That leaves you 35% to pay your taxes, put food on the table, put gas in the car. I mean, have some sort of lifestyle. Like, that doesn't leave you much. I have heart to hearts with a lot of folks that do that. Like, look, you know what you're doing, right? You understand what's going on. This is what you're going to be left with at the end of the day. I'll do their calculations for them. I'll show it to them. I have no problem in being real with people, because at the end of the day, I'm kind of fiduciary responsibility to my clients to kind of give them a heads up. I don't want you to be house poor. I don't want you to be eating ramen noodles and living in this house and then like swearing at me behind the scenes that I didn't break it to you and wasn't real with you when you were trying to buy that house. So look, 65% is an enormous number, but they can do it. Okay. FHA loans, y'all, 55%. FHA, do you guys realize FHA does not stand for first time home buyers? FHA is a federal housing authority, and that was created to help debt challenged individuals to purchase homes. So if you're already debt challenged and you've got lousy credit, which is the only reason why we're going to use FHA to begin with, why are you going to push yourself over half of your income in pre-tax dollars to pay for your debts? It doesn't make any sense, but people do it. And again, I'm having heart to hearts with folks left and right, especially nowadays. And, you know, I would rather see them save up some more money, improve their credit, buy a little bit less house, figure out that comfort zone, help them get into that comfort zone for a monthly payment so that they're not busting out the seams, just trying to live from paycheck to paycheck. 55% for FHA. Conventional loans, you guys, are usually 50% if you have compensating factors, which means that like you have decent credit, or you've been on the job for a while, or you're putting good money down. There's multiple borrowers on the loan, so there's less risk to the bank to lend that money to more people, right? Because you have more pockets to pay that out of, right? So they see these as compensating factors, and they'll let you push it to 50%. Sometimes when you have slightly lower credit scores, you keep bouncing around on jobs, like the system sees this, right? There's an automated system that sees this. We have to submit it through before we can get to a live human underwriter. We need to get an automated underwriting system approval, right? And those are called DU and LP. I'm not going to go into those, but that's what they're called, right? So you're talking about up to 50%. Now, sometimes with that questionable stuff, it might push you down. It might say 47%, sometimes 45%. And Matt and I will play with the different numbers and kind of try to figure out, like, where's that break point? Where's the system like this client? There's got to be somewhere, right? And sometimes, Matt, it's pushed us down to like 41% before, right?
Yeah, sometimes it's pushed us to no percent. Sometimes we're just like, hey, there's an error on this. We can't get it to work, and send it to IT or tech support. And they're like, yeah, credit. They just can't overcome this hurdle. So
Yeah,
we have to put a
sometimes
stop
it's
to
just
it.
a flat no. Sorry. And those are tough conversations to have with clients, like I want to help everybody buy a home, but sometimes it's just not the right time. And that's okay. There's nothing wrong with that. Look, when I went to buy my first condo in San Diego, my loan officer who recruited me in the industry almost a decade ago, he was like, look, Ed, he's like, you just got here. You don't have enough money for a down payment. You're borrowing money from your mom to like buy this condo. Like you're going to be stretching yourself so thin. I don't have enough history to be able to justify this. He's like, you should wait a couple of years. And thank God I did, because I almost bought something in 2007. And so I was lucky that he said, hold off, because I want to buy in a place downtown in 2012, but that was years after saving money, working on my credit, and like getting things in the right position to make the biggest investment I had ever made in my life, a $450,000 condo. You guys, it's $500,000. It's a lot of money. It's a lot of money. And it's in San Diego. And like, we don't think about these things. And like, but you go out to the Midwest, someone buying a $450,000 home is a mansion. The places are huge. And here, and like their average loan sizes are like 100, maybe 200 for a really nice house. Here, we're like, we don't even blink at $1 million. Like, oh, it's $1 million. It's a starter home. Like, it's insane, but like we get so jaded here, right? So let's get back to debt to income. So we have conventional loans, right? Those kind of they'll fluctuate. It just depends on every scenario is a little bit different. Okay. But there's a lot of different variables that go into that just besides your debt to income. But the debt to income is what drives your purchasing power. Okay. And it's what drives it's going to drive your monthly payment, obviously, right? And how much you can afford, and how much you're approved for. So then you have jumbo loans. Jumbo loans are very rarely do they ever go over 41 to 43%. Unless you're putting a lot of money down. There's like 1 or 2 programs that'll go to 45%, but most of them between 41 to 43. Sometimes they're even lower if they're more out of the box, non-qualified mortgages. All right. So that being said, in order to be able to qualify for these, in order for us to be able to calculate your debt to income levels, the debt, like I said, super easy. We run your credit, right? How long does that take? It doesn't take long at all. It takes minutes. Okay. But in order for us to calculate your income, that's where it gets complicated. So for regular, everyday, standard borrowers, I'm going to share my screen with you guys so you guys can see what I'm going to be talking about. So can you guys all see the matrix kind of on the screen there with a list of all the documents? So in order for somebody that's just has a regular W-2 job, right? And they're getting paid a salary, easiest calculation on the planet to make. Very few people actually have salaries. Most people have variable sorts of income. Not a lot of people live on salaries anymore, believe it or not. But those that do, super simple. We're getting a pay stub for a month, right? Because we need to see the year to date. That year to date is really critical in our calculations, because if there's anything that's off with that year to date, we put in your hourly, for instance. We put in 40 hours a week, 30 hours a week. You tell us how many hours you work. That's how many hours we're putting in there, usually 40. And if it doesn't jive with the math of where we're at today with that pay stub, and there's something skewed, if it's way too low, right? Something must have happened during the year that caused you not to make that much money that you should have made if you had worked the 40 hours. So we need to dive into that. We need to find out what happened there. Did you take a leave of absence? Were you on maternity leave? Was there, a death in the family? What have you? We need to find out what happened there and why the income was off, and whether or not you're actually working less hours than you told us, or that just something like it was a blip in your life that happened, and we can overlook that. Okay. And then we're going to also compare it to your last couple of years. Right. So salary, again, super simple. Hey, I get a 3%, 5% raise every year. It's very straightforward. It's really hard to screw that up. I'd say maybe 5% of our applicants maybe are just strictly salary. I mean, the majority, like the easiest salary for us is VA. Like they're straight salary. Like hey, this is what they make. It doesn't change month to month. Like we know exactly what they're going to be making. That's the best example of a salary. Otherwise, you have bonuses. You got commissions, right? So if you have bonuses, you have commissions. If you're on that kind of income structure,
overtime.
What's that?
Overtime,
right? We need to know. We need to know a breakdown and average it out for a couple of years. So with your current income, if you were on a salary, I can use your current salary. Okay. I don't need to average anything. I say, hey, I'm making $5,000, $6,000, $10,000 a month. That's what I'm using for an income. You have fluctuations in your income. Now we're averaging across the board. Now we have to look at what you did 2 years ago. We have to look at what you did last year. We have to look at what you've done year to date. And we have math formulas to figure all of these out. And these math formulas are going to drive what your calculations look like. So we need to plug in 22, 21. We need to figure out what what your average is. Is it declining? Is it inclining? If your average income has been going down significantly, we need to use worst case scenario. If it's been going up, guess what? We're still using worst case scenario, no matter what. So we're going to calculate it every which way to Sunday to figure it out. And we're going to take all these numbers and we're going to submit everything over to our underwriters. Okay. So, but before we do that, that was just like the tip of the iceberg. So now we have your pay stubs, we have your W-2s. Well, what if you have those bonuses? What if you have those overtime? We need to get that breakdown for the last 2 years. So we run verifications of employment, and we do this up front, you guys, because it takes time. Sometimes these verifications of employment could take a week or two. And if we don't know line by line, because we have to average your bonus separately than your overtime, separately from your hourly. Okay. And if we don't have that broken down over the past few years, we need to reach out to your company. Some companies take a couple of weeks to get back to us. And we will constantly hit them up every few days. Hey, can we get this form filled out? Can we get it back? Some of them are automated, like bam, we'll pull it right up. Sometimes when it's automated and we pull it up, it's all clumped together, but yet we can see on the pay stub that it's broken up. So then we need to reach out to the company. And the reason why I'm saying all this is because it skews people's income significantly. If they had a bonus a couple of years ago and they haven't got a bonus in 2 years, but yet in their mind, they're like, oh, I might get a bonus, and they shove that into their income and they think that they're living on this bonus that doesn't exist, or they put this overtime that they made last year and they're like, oh, I had my best year ever in 2021, and they wrote that income down. And now we look at this year, it's declined significantly from every perspective. We need to use worst case scenario to calculate this. And we can't possibly, again, going back to our Uber driver, use $171,000 when he's writing everything off, right? So that being said, when we have self-employed borrowers, because that's what an Uber driver technically is, right? They're self-employed. We'll need your tax returns. We need to see exactly what you're writing off. That could take a little bit longer to get to us. And we need all the pages. We can't just have like the first couple of pages because that's what some people will give to us. We need to see everything because some people will have LLCs set up in the background. They'll have other expenses. They'll have other like partially owned companies that they have. There's all sorts of ways that people make money Some of them will be trading crypto and they're showing huge losses, what have you. Anyways, we need to take all this income into account. So when you're self-employed, we're diving into tax returns. That's not necessary when you're working for a corporation. Okay. So you guys, when you're speaking to your clients and you're chit-chatting with them, oh, cool, and you get into kind of know them. What do you do for a living? Oh, great, I'm a nurse. Well, you know that nurse is going to have a super complicated income, right? They're going to, and the only reason I know is my wife's a nurse, right? So, well, that and we do a lot of nurses, incomes too. So they're going to have regular hours, overtime, double time. If they're working nighttime, they're going to have nighttime differentials, nighttime overtime differentials, double time, nighttime, double time. They're going to have paid leave. They're going to have sick leave. They're going to, I mean, they have like 10 to 12 streams of different forms of income, and we have to break them all down and we have to calculate them all out for the past couple of years. So if we can't, a lot of times what helps us is to get that final pay stub from the year. That really helps. So when you're talking to your clients and you're like, hey, yeah, so if you're going to be getting ready for your loan, make sure, you pull out a couple of, your W-2s and your pay stubs in your bank statements, because that's what your bank is going to want to see. All right. And it's okay to kind of prep them. It's okay to let them know, like, hey, there's usually not a lot of paperwork involved, but you definitely want to get these things ready because they're going to ask you for it at some point. And that'll kind of give them a little bit of a jump start as far as being able to go online and look for them and download them and so forth. But also knowing that self-employed borrowers, as opposed to your day-to-day employees, are going to have a much more difficult time qualifying for loans because they do what every self-employed borrower does, and they write down their income because they don't want to pay taxes. And unfortunately, if you write down your income to next to nothing, that's what we're going to have to use. We can't use the top line of sales receipts of gross income. We need to use the bottom line of everything that you wrote off. Especially this time of year, you guys, coming into January, February, I do a lot of tax planning. I know this is live on YouTube and maybe I shouldn't be talking about it. But I do help my clients with tax planning because I do understand tax returns. I have a finance degree and I don't mind helping them figure out, hey, this is what you need to claim for 2022 with a combination of year 21 in order to be able to afford this home. And I will back into an income and show them what they need to do. It's up to them how they want to do their taxes. I'm not going to give them any tax advice of what to write off and how to write it off. I'm just going to show them like, hey, this is the income that you need to have to be able to qualify for this type of loan. So we'll need those 2 years of tax returns from those clients. But not only that, if somebody owns more than 25% of a corporation, okay, we need the corporate taxes too. A lot of times they're not comfortable giving it to us because some of the partners don't want to give it to us, but they're going to have to if they want to take out a loan, because we need to see what the corporation's doing and if it's a liquid corporation or it's actually like dying out. So that's another thing, right? So corporate taxes and or your personal taxes. And if you don't own 25% or more of that business, we can get away with K1s. Which people are given. It's a form and it says how much income that they received from the company that they owned. So we look at all these things, right? Obviously, when they get into a transaction, we're going to need, their purchase contract. We're going to need their earnest money deposit, for instance, right? But that really doesn't have much to do with their income. It has more to do with their assets. So that's kind of a general overview of what we would need for paperwork, right? Any questions so far? I know I kind of covered a whole bunch of stuff and been kind of going at it for 20 minutes. So anybody? No? Everybody, everything making sense so far? Yeah? Cool. So your debt to income, you guys, we're going to calculate that income line by line. We're going to figure out exactly what they qualify for. And once we do that, We're going to take all that paperwork that we received, and not like every other bank out there, it's that paperwork kind of stays on the loan officer's desk or in a folder with the loan officer. We actually take that file and we submit it to the underwriter. And like I said, that human being, that underwriter, that person's going to make a determination whether or not to lend you money. It's not us. We're salespeople just like you guys. We're on the phone. We're the quarterback of your team. When you get into escrow, we're the ones that are making your escrow move forward, making sure that disclosures get ordered, for your buyers, and the appraisals are ordered and they come back and everything's submitted properly. And we have a proper structure for the loan and rates are locked, and we're communicating with escrow and title and your assistants and the buyers. And the seller's agents, and just keeping everybody on the same page and pressing everything forward, right? So we're really honestly talking to everybody and quarterbacking that transaction for you in the background. But that underwriter is your best friend, is my best friend. I talk to my underwriters all the time. There's a lot of banks that still have firewalls. You go to big banks like Bank of America, Wells Fargo. Those guys can't talk to their underwriters. They're not allowed to, not directly. They have processors to do that. They have a middle person to do that. My loan manager, we get on conference calls and we hammer things out together quickly. That's why it happens so fast. That's why we move through these loans. And we're slamming conventional loans in 10 days, not a problem. So again, it's one of those things where we have to make sure that that income is perfect. It's down to the penny. And we're gonna order those verifications of employment. We're going to wait for them to come in. We're going to fill out our spreadsheets. We're going to submit all of our documentation over to our underwriters, and that underwriter is going to double check all of our work, and they're going to give us all the conditions that we need for a final loan approval. So we've pretty much been underwritten for a loan as if you were already in escrow. The only part that's kind of laying out there is your collateral, is the house. So it's all TBD. It's all your address is to be determined. But we have you qualified for a home, for a loan. We know exactly what the red flags are up front. We know exactly if there's any one of them that we're not going to be able to handle, and we'll tell you that, and we're going to hammer that out in advance, and we're not going to let you get into escrow. Like I've got one right now where the lady's going through a divorce, and I'm like, I can't close your loan without a divorce decree. You were never legally separated. You don't have a separation agreement, which I could use. You don't have that in place. How do I know if you're not going to have to pay alimony? Because that's going to affect your debt to income. That's an outgoing debt every month. And that's what the banks care about. Do you have enough income to pay all your debts? Do you have the capacity to pay back that loan? Does all this make sense, y'all? So when you're talking to your clients, okay, get a feel for what they do. Ask them. It doesn't hurt. It's okay. I mean, I want to know what my clients do for a living, not only because like I have to do their loan, and I need to know how I'm going to figure this out, but I want to get to know them, right? Cool. So what do you do for a living? Oh, really? You work, I work as a traveling nurse. I work as a contracting computer science person and programmer, right? Think about it. You're on contracts that expire. Well, guess what? You need 3 years of continuance of your income in order to be able to use that income. So if your contract expires in a year, I can't use that income. So it makes it very, very difficult in order to be able to qualify folks that are on a contract basis. Makes it very difficult. And it's tough to be able to say no, especially when they're making, 6 figures. But they have to have a significant history, at least a 2-year history of doing what they're doing. And they need a contract in place. As long as we can get around the entire contract thing and they're working for this person. If they're getting W-2s, we might be able to get it around that. But if they're getting 1099s, y'all, and they're submitting a Schedule C on their tax returns for self-employed borrowers, that's what they do. We're not going to get that loan for. But you know what? They're going to get an approval letter somewhere else. It's just going to hit the fan when you get into escrow, because no one's ever going to take that and take it to the next step. And do that extra due diligence and make sure that those clients are totally dialed in. And that's really the most important part of our job. So asking these folks what they do for a living will kind of help you put things in the back of your head, as to, oh, okay, so this is probably good. This will be an easy, like, I should be able to tee these guys up and, like, make sure that we're getting approved first. We want to go through underwriting, whatever bank that you're dealing with, whether your clients already have a lender or they don't. Ask them to ask their lender, hey, is a human being going to be underwriting my loan, or do you just use an automated system? It makes all the difference in the world, you guys. I can make anybody qualify through an automated underwriting system. You guys, shit in, shit out. I can put any kind of information in there and I'll get an approval and I can spit out an approval letter. But at the end of the day, that approval letter isn't worth the paper that it's written on. And then I've wasted not only your time, but the client's time. And guess who's never going to call me back? Neither one of you. And I don't want to blame you. But we don't do that. We have to take those extra steps. And sometimes those extra steps take a little bit longer. But you know what? There's no such thing as an emergency in real estate. Okay. Like, I've had maybe like 2 people in 10 years that are like, oh my God, I'm getting evicted. I need to buy a house. Or, oh my God, like my landlord's selling the home and I need to buy a house. Well, guess what? I'm not helping the person that's getting evicted because their credit probably sucks. But the other person I could probably help, right? So look, at the end of the day, it's so important to know what debt to income is and get that dialed in perfectly, and having a human being going through all these steps, because you guys can go out and fill out an application and get an approval letter anywhere, but it doesn't mean anything. And I don't want you guys to suffer, and I don't want you guys to waste your time and your energy, and go out there and lose clients because you just took their word on it. So make sure you're asking them, hey, the bank that you went through, you got a qualification letter. Did you submit any documentation? Did they go over your monthly payments? Are you comfortable with those monthly payments? Do you know what price range you should be shopping in order to get those monthly payments with your down payment that you have? Because if they don't, and they got approved because they have a good income and they have a very low debt to income of $1 million, $1.5 million, 800, and then all of a sudden they get into escrow and somebody finally shows them what those numbers look like on a monthly basis. Why do you think so many people are falling out of escrow all of a sudden? Because the loan officers suck and they're not taking their extra time, because we have plenty of time on our hands, you guys, just like you do right now, right? All we're doing is following up with people and calling everybody and making sure that we're staying top of mind. But so many loan officers don't take the time to and don't care enough to sit down and break it down. We use software called Mortgage Coach. We can do that on another call and show you guys what it looks like. But I can show somebody 4 different loan scenarios, show you what the maximum purchasing power looks like, and then show you back into that comfort zone on a monthly basis, given your down payment, given the type of property that you're looking for, and show you, hey, you should be shopping in this price range to make sure that you're comfortable with that payment. Because that person that's comfortable with that payment, that person that can transact right now, they're going to get a deal on a house. The deal is that they're going to be able to buy a house for less than listing price sometimes. That didn't happen less than a year ago. Granted, their rates are a little bit higher. Well, guess what? Those rates will come down. They'll be able to refinance. They'll be able to save a whole bunch of money later on. Dan, I see your question. Do HELOCs die with the crashes, or do you still see them? We still see people taking out HELOCs because they want to tap into that equity, but they don't want to refinance at 2.5%, 3% rate, right? So they're taking out the HELOCs, and even if they're at 8, 9, 10%, 11%, it's still better to take a small HELOC at a higher rate and leave the bigger loan alone, right? And just pay that off, because that HELOC, it's variable, it will come down in rate as well. So it'll adjust with the prime rate. When we actually, Movement Mortgage just came out with one, say 4 months ago, something like that. But literally, like within a week, you get your money. it's nuts. Like it's all automated. We have nothing to do with it except here, send out an email. Here's the application. I went through it myself. Within minutes, they do a soft poll. And within minutes, it gives you, here's your different options. It has automated appraisals that it runs on the back end, given your address. It knows what your home is worth. And it says, hey, I'll give you up to this amount of money. And then you can play with the scale to see how much money you want. You want to pay it back. I think that there's a 2, 3, 4, 5 year fixed period. And then there's like an additional 15 years to pay back, 10 or 15 years. You can play with it however you want and structure however you want, but it takes minutes, and then money's in the account really quick. So I've had nothing but really good responses from it. 2 people have already got, and then 1 person got denied. So it works. It knows what the value of your home is. He just bought it in March and he's trying to take out a home equity line on a VA loan. The guy didn't put any money down. I mean, your house didn't appreciate that much. But I wasn't about to tell him that. I'd let the computer system tell him that. Question, you guys, is this helpful? Did you guys learn anything today?
Yeah, just to kind of piggyback on what Ed said, nobody, 0% of the time has an applicant put exactly the right amount of monthly income that they make. You would be surprised at how many people think that $100,000 a year equates to $10,000 a month. I have an IT guy. He says, I make $10,000 a month. Oh, that's awesome. You make $100,000 a year. Do some math with me. $100,000 a year is not $10,000 a month. So there are people who make salary and can't do simple math. So let us do the math for you. Let us get their debt to incomes right. Let us get them pre-approved up front, and don't get into escrow. Day 21 comes and you're like, remember that $10,000 a month that you said you made?
Yes, help us out, please. Okay, we need to close in like next week.
Yeah, it's actually 8,300 a month that you're making. So that's a huge difference.
Yeah.
Don't find that out on day 21. Find that out on hour 6.
Right. Well, because honestly, you guys, most banks will process these loans first. Like 95% of banks process first. We underwrite first. It's completely backwards. But we underwrite. As soon as I get that file, I submit it through underwriting. If you give me a live file, I submit it through underwriting. It goes right to the underwriter first. They have 6 hours or they lose their bonus. If they don't get back to me in 6 hours with an approval, they lose their bonus. And I'm really thorough when it comes to docs. I'm not going to submit anything that's lousy. So I submit everything. I know exactly what conditions I need within those 6 hours to get a final loan approval.
There's somebody incentivized to get your approval out up front, so you're not wasting your time on day 21. There's people getting paid to make sure that you're good to go.
So then my assistant, she's going to go and process that loan. And by process, I mean, she's going to order your appraisal. She's going to ask for all the conditions that the underwriter asked for. She's going to process the file, right? And to get all that paperwork. Most banks process that file first. And honestly, like we have if I have a hot potato, I put hot potato into my subject line and people know that I need someone to look at this file right away. Good luck, Wells Fargo, getting that file to get up to the top of the line. Because what happens if somebody doesn't give you everything, it goes down to the bottom and they work on the next one. It goes down to the bottom of the pile, they work on the next one at a time. And when your turn comes, that's when it's going to get taken care of. And if that turn comes in a week from now, well, guess what? You got to wait a week from now. And that's not how you want to roll, because you guys have contingencies. So that's why it's in the name, right? Movement. We're constantly hustling to get these things done as quickly as possible. And it's just nice. It makes it for a smooth and referable process for you guys too. Hey, that was awesome. Like, I'm definitely sending everybody your way. Like, I want you to help them purchase a home. Eddie and Matt, I want them to do the loan. That's how our entire business is built. It's strictly referrals. And we wouldn't be getting referrals if we sucked.
Well, and it definitely helps you guys get offers accepted, right? I know offers right now, they're kind of far and in between, but hey, if we could close this loan in 2 weeks, is that going to benefit your sellers? If we get you your seller's money in 2 weeks, do we have a deal? Yes. All right, we'll close the loan in 10 days.
Questions, you guys? I know we kind of went over a little bit. I try to keep it to a half an hour. Sometimes I talk too much. No? Cool. Well, I hope you guys are off to a great Monday and got your juices flowing with some new information, and asking some good questions when you're chatting with your clients. Don't be scared to ask them what they do for a living. Don't be scared to ask them, hey, have you had any credit events in the past couple of years? Like, anything ever happened? Like, are your credit good? All right, cool. Excellent. Hey, you just need
that chapter 7 would be good to know up front.
Yeah, it's okay to ask these questions. I know most people aren't comfortable asking them. We do it all the time, so it's kind of like it's an everyday thing for us. But I'm telling you, some of the strongest agents out there, they know what we do for a living. They know what we're going to ask them. They're going to ask those questions first because they don't want to waste their time on somebody that has no business looking at $1 million home when they're working at, I don't know, Walmart. Okay. Even the Walmart guys that are making $18 an hour are not going to afford $1 million home. I'm sorry. We'd love to help them out, but they're not going to. So just ask the questions. It's okay. Be that top agent, because I'm telling you, all the top agents I work with, they know. They tell me when they call me up, hey, I've got this guy. He makes this amount of money. He says his credit's golden. He hasn't had any events going on. He's got this much money for a down payment. Get in touch with him. Get a hold of him. Get him rolling. Done. That's how my top agents communicate with me. And I want to see you guys do the same thing. So you guys, Monday, I hope you guys have an awesome week. I will see you guys tomorrow on Scripts.
Join us next week in person.
Yeah, next week. Next week, you guys, Barry Habib, y'all, please don't miss him. This guy is like one of the smartest economists in the country. We're going to be doing an in-person watch party at the office if you want to join us in person. But I will also be streaming it on Zoom. But you'll need to log in and register through the Barry Habib link that I'm gonna post it back out. I'll send an email out to everybody. So please make sure that you're there. 10 o'clock next week. The guy is so smart. It's incredible, and it's so refreshing to listen to him, and he gets so amped up after listening to him. He's the man. So thank you guys so much. I hope you guys all have an awesome week. And if you guys need us, y'all know how